All right, folks, welcome to this video here where we've got retail versus hedge fund algos by Charlie at Ariel Fx. Now, we've got Nathan giving us a wee intro to the video, so I won't spend too much time on here. Then we're going to jump into Charlie and go through this presentation. You're going to find out how this EA works and a whole bunch of other things. So let's just get on with it. Introducing CTI Quant from my sponsors, City Traders Imperium. At CTI Quant, the choice is yours. You can leverage their tried and tested portfolio of algos to help grow your wealth. Build your own automated system for MetaTrader 4 or 5. Take your trading to the next level with their smart money, trend reversal, volume, and cycle trading tools, or they can turn your own trading ideas into automated solutions. To find out more, visit cti-quant.com.
Hey, what's going on, ladies and gentlemen? Many of you probably already know me from Trading Nut, but if not, my name is Nathan Jester and I am the CEO of Ariel Fx. I am very excited and thankful for the opportunity to introduce our former client and now business partner, Charlie. Charlie was a very successful student of ours when we first launched Ariel Fx, and he was really the first person to introduce us to the automated side of trading. And so we decided to come together to integrate and automate many of the concepts that we teach. So in the screen share to follow, Charlie will discuss how algorithmic trading is supposed to work, the key components needed to make it a sustainable and long-term form of investing, why nearly all algorithmic traders and traders in general fail, how to properly shift your mindset into understanding how risk works within algorithmic trading, and the fundamental differences between how retail algos trade and how hedge fund algos trade, and how you can take advantage of the secrets big funds don't want you to know. Guys, not often do we have the opportunity to learn from someone who understands both how to trade the markets himself and how to code sophisticated algorithms. So without further ado, it is my pleasure to introduce Charlie, and I have no doubt you will find all value in this presentation. You're not going to want to miss this.
As some of you might know, the Ariel Fx team and myself trade smart money concepts. So today I've prepared a brief overview of how we went about automating smart money concepts and how we spent the last 18 months improving our EA and developing the best EA we can possibly provide with the resources given to us to the retail market. So firstly, to understand what we actually try to do, I need to give you a brief overview of how algorithmic hedge funds look at the markets versus the general algorithmic retail trader. Looking at risk and return, we know that hedge funds don't really want to do more than 15 to 20% a year, or they generally do not do that. Whereas we know retail traders are looking for much higher returns generally because they are trading smaller accounts and they want to compound faster. Now, secondly, we need to look at strategy management. From an algorithmic hedge fund point of view, they tend to run a basket of strategies, sometimes even over 100, which all run in tandem to create a cumulative profit at the end of the month of a 1 or 2, maybe even 3% return. The difference is retail traders tend to look for a higher return from a single strategy. Okay, now obviously there's a lot more risk involved when you're trying to generate a greater return from a single strategy, and the probability of failure is much higher as well. Algorithmic hedge funds tend to manage their strategies very actively. Every 2 or 3 months, they will throw out their strategies, add in new ones, and they tend to have teams of data scientists, developers, and analysts working together just to keep their portfolio running optimally. Whereas retail traders and retail algorithmic traders do not have the same resources to utilize. Now, we're also going to look at the general development of retail algorithms and the issues going about there. Now, most retail algorithms are created by, obviously, coders who don't really have, in general, the best knowledge of the markets trading-wise. So they tend to use traditional indicators, patterns, etc. to get into the markets. And we don't believe that is the best route to go. And this drives into a even deeper problem: supply and demand in the retail algorithmic trading industry. Now, what do we mean by that? It's just the retail trading industry, algorithmic trading industry, are obviously buyers of the software, this algo, and developers are going to supply and meet that demand. Now, in the forex markets and trading in general, we know that retail traders tend to have a very unrealistic view on return. This creates a massive problem because retail traders are looking for algos that do 10% a month or sometimes even more. And now developers are going to try and meet that demand by supplying algos that do 10% a month or claim to do this. Just bear in mind, I'm using 10% as a ballpark figure. But yeah, now we have developers meeting the supply and demand, supplying this demand. And this creates an issue because these unrealistic returns are creating developers who create bots that will blow. They are not sustainable nor realistic. And we're going to dive a bit deeper into that later. Now, I want to run through the challenges we faced in development. And we were faced with a massive challenge. We wanted to make an EA available to the retail market that works in every market cycle. It generates a moderate return with low risk. It's consistently profitable, that needs minimal to no management. And we wanted to do as little or actually no optimizations, which will ensure a higher probability of success in the long term. Now that you're familiar with our goals, I want to run you through how we achieved them and kind of how we took on these challenges. So we based our strategies, our entry strategy or fundamental smart money concepts, and we used higher time frame trend to develop our directional bias. Now on the lower time frame, we're looking for confirmations, so we're looking for breaks of structure, etc. Now we know that we tend to get large reactions off of these smart money concepts, POIs. So we developed our strategy around those reactions. We were looking to scalp, and we tend to see these reactions in every single market phase, whether the market's accumulating, expanding, distributing. We tend to see these reactions in all of those phases. Now, secondly, we need moderate return and low risk. This was, of course, our most daunting task, and it's still an ongoing process. We're working on that every single day. We realized it's unfeasible or unattainable to create an EA that will work with a fixed stop loss for 10 plus years, just because of how the market's constantly changing and you can't keep up with the market cycles. Since there's no intervention, we can't make changes to cope with that. So we took on an unconventional route. We decided to dollar cost average, and to a lot of people who've used Algos before will be scared, right? It's got a really bad rap in this industry, but trust me, once you understand how we dollar cost average, you will rest easy. And yeah, it's really awesome. Now, the little to no management phase, since our risk management technique revolves around cost averaging, we didn't have an issue with active management, and our strategy should work, and we hope it will work in the future. Now, our entry strategy, how did we do that? We based it off of smart money concepts. So what did we need to do? We needed to do multi-time frame analysis. Okay, we needed to look at higher time frame structure and continuation zones, as well as lower time frame confirmations to ensure we get that reaction. So firstly, the EA is constantly trying to get into the market. It's trying to sell at a premium and it's trying to buy at a discount, right? So it's using the higher time frame, so whatever you set the EA to look at the higher time frame, it's using that data to look at market structure. So in this case, we're looking at the 12 hourly. So the EA is going to develop an area of interest, right, on the higher time frame, where it's going to look for lower time frame confirmations. And we see the same thing over here. So just a quick introduction. We have a sell to buy movement, right? We sold off before we broke this high. So we created a new high in this area, and we are looking to enter in this region. This is our area of interest. Now the EA is going to look for lower time frame confirmations within this area of interest. So the exact same applies for the previous slide. Here we had a buy to sell movement. We broke the previous low, so we're simply just looking for a pullback into this zone and then a continuation to the downside. Now that we have that under the belt, I want to actually show you how the indicator works in MetaTrader itself. So this is just a back test, just some period in 2020 on the 3-minute time frame. I'm just going to go ahead and pause the video here so that it makes sense what's going on. I set the higher time frame to 4 hours, so it is looking at market structure on the 4 hourly time frame. The area of interest, right, is set between the 61.82 fib and the 92.22. So between these two areas, that's where it's looking for a confirmation. And if we just dive a bit further into the video, I'm going to show you how the indicator actually graphically represents these AOIs on the chart and all the information it is shooting through to you. And just open up the strategy tester, and this pink like a line over here, that is representing higher time frame market structure. Okay, since we're on the 3-minute over here, this pink line is actually representing market structure on the 4-hourly time frame. Okay, I hope this makes sense. Now this bluish turquoise line here, that is describing, or box, that is describing our area of interest, as I showed you on the previous slide. Now the dark blue or purple box, this is a bearish POI, whereas this was a bullish POI. Now this is a new bearish POI that formed, and as you can see, there's a POI. Right, we're looking at market structure there, the previous low on the higher time frame. We broke that low, pulled back into the AOI, broke lower time frame structure, and printed a signal. So we would have gotten into the market over there. And yeah, the EA is constantly updating its AOIs. Right, we have a new one that formed there. Now we have a bullish AOI forming here, and there was a buy signal down there as well. I hope this makes sense and kind of clarifies the entry strategy. I know this was a brief overview, but we don't have all the time in the world. Now we are going to go on to the risk management system. I'm going to cover this quite quickly, but as some of you might know, dollar cost averaging works by adding positions as price moves against you. Right, so what we're doing is we're adding positions at buy to sells, right? So high probability reversal zones. And we're adding it at the 50% of these buy to sell movements, or the 50% retracement. Now, this allows us to get into averaging positions at high probability reversal zones. And that just allows us to get out of positions faster, and it's just a much better route than traditional dollar cost averaging methods. Now, profit taking is really interesting and a bit complex, but there will be a visual representation that will help with that. But just to make some sense of this, the EA closes positions, right? When the biggest position in the sequence, okay, so the newest position in the sequence of trades that it has opened, its profit, so when this one's profit that it's in is greater than this one's, the smallest position's drawdown, plus X profit, it will close both positions. So it's going to close your biggest position and your smallest position simultaneously with a net profit. What that's doing is it's lowering your average order value and allowing you to get out of positions with small pullbacks in the market, creating a very safe strategy if you're running the correct risk. Now we're going to run through the visual representation. The EA allows you to test and trade as many pairs simultaneously using one version of the EA. So you just have to set it up on one chart or one back test. Now running through, I'm just showing you the different time frames. So the EA is, in this case, is monitoring H1 for higher time frame structure, M1 for entries, and the daily time frame it's using for ATR information for entries that are out of the look back period, which I'll explain later. We got into a AUD CAD buy over here, and price is pushing and moving against us. So we added an additional position here. We didn't quite get a big enough reversal, and another one here. Please note, this is our first position and this is our biggest position, and this is just going to display what I was trying to explain before. What's going to happen is when we get a pullback, this is our new biggest position. When price pushes, right, when this profit is larger than that drawdown as just occurred, we close both positions, okay, with a small profit. Now, I just want to skip a bit forward in this back test just to deal with some time constraints. So as you saw over here, it replaces a position that it closed. Obviously, you're out of this, and now you have the volume sitting here again, but you don't have the drawdown. So that's really, really useful. So I'm just going to skip a bit forward, and we're going to dive into the rest of the video. Okay, now it's the exact same trade. From what I can see, we haven't closed any additional positions. So we're pretty much just waiting for a push further down, right? And then we'll add additional positions, or we're going to get a push up and we are going to get out of this trade. Now, traditionally, we don't average as closely as in this example, but just for time's sake and just to make it a bit more convenient for me, I decrease the distances. So yeah, as price pushes and moves, a lot of times we take hedging positions. So as you can see here, these are all sells while we're sitting in buy positions. Okay, so if the EA receives a entry signal that is in the opposite direction of its current trade, it's still allowed to take that trade because it is scalping. So we're just benefiting and profiting while we're stuck in a position. So yeah, as the sequence moves down, we open positions, and now we're constantly trying to get out of our position that's in the worst price, so our first position. So there we managed to get out of our first position, closed the largest position, and we replaced, I think we replaced this 0.1. Okay, so when we get our next push, we're going to close this whole position, hopefully. And this is what the EA is doing constantly on as many pairs as you would like. But as you can see, the risk we're running, we're starting off with a 0.05 lot size on a 100K account. And that just ensures you can sustain a 5 to 6,000 pip move against you, which will occur eventually if you're looking to do this for 10 plus years. So that's obviously compromising return quite a lot. But if you have that long-term mindset and picture, you will understand what we're trying to do. So as you can see, we got out of all our buy positions, and we're just left in a sell that we opened as a hedging position. So yeah, on to the next talking point, the theoretical trade function. Okay, this one is a bit complex, but I'm going to give it my best shot. So with dollar cost averaging, a lot of you might know, a lot of developers tend to create algos that do end up blowing. Now, we decided to take a very different take or have a different view on averaging. We thought if we skipped the first few sequences, right, we receive a signal to enter the market, and then we take trades and add our positions theoretically, right? So the EA is just storing this memory in the computer's RAM, these trades. And then once we reach a certain amount of stacks, right, we drop the whole position, we drop the position at that point, the cumulative position. And that just allows you to get in at a much better price and take a bigger profit. So we're hopping into that same AUD CAD backtest, the exact same period, and we're going to be looking at the same AUD CAD trade as before that we took using our traditional cost averaging method. So as you can see here, I have flipped on theoretical trades and I have set that to 3. Now what does that mean? That means we're going to take 3 theoretical trades, right, before we actually execute a live position. And you're going to see that take place right now. So we are coming up to the point, there it is. So this is where we took that other buy position on ACAD that we sat in drawdown for a while that we discussed in the previous video. Now, as you can see, I took this trade theoretically. So this isn't a live trade. The EA is just storing in its head that it took a 0.05 lot size trade over here, and it's managing the trade exactly as if it were a live trade. So if the trade hit TP, it would close this theoretical trade and forget about it. But in this instance, we know the trade is going to move against us. And now you can see as it unfolds, we take another averaging position, this time at 0.06, theoretical again. From the input settings, you can see that we are going to take a total of 3 theoretical trades before we execute a live trade. So here's another theoretical trade. Then as we continue to push down, and if we have another push down, we should then open a live trade. And there we go. Okay, now we've dropped a 0.08 lot size, at this price point down here, instead of sitting in drawdown all the way down, right, we've improved our cost, right? We've got in at a better price. And that allows us to determine, by doing a lot of back tests, we can figure out, okay, where or when is the highest probability of reversal. So looking at AUD CAD, we can test 15 or 20 years of historical data, and we can deduce that, okay, AUD CAD on average will take a total of 6 positions or 5 positions before it has a 40% chance of reversing. So we're looking at that data and taking that to get into the market at better prices. And as we know, right, the EA is taking a very small profit. So when the market's expanding, it's trying to get out with every little pullback. So if the EA gets into a lot of positions, we know that we've most likely experienced a linear move against us. And using some smart money concepts, we can assume that there's imbalance sitting below the trade, right? There's imbalance, and we can look for a reversal. So that's just a couple of confluences we use that help quite a lot in our daily trades. So I just want to skip forward a bit. I don't want to waste too much time as we're sitting in this position and managing it. So I actually want to show you guys when we get out. So as you can see, the profit target is a lot higher than it was previously. And that is because we're getting in at a much better price, and we expect kind of the same size pullback. So I know I've cherry picked this example, but that's obviously for display purposes. Now, going into the next slide, okay, we need to look at long-term rewards. The issue is with the industry at this point is everybody's trying to get rich in a day or in a month, and it's just not feasible. It's not possible. You need to start looking at trading as like, make a commitment to it. You're going to be doing this for the next 10 years, and you need to figure out how you're going to do that safely, consistently, and profitably for the next 10 years. Not for the next month or for the next 2 months. Now, the first thing you need to do is figure out, okay, what return am I going to do? And trust me, that 10% a month is just not feasible. It's not possible. I don't believe you can do that long term without slipping up. Now, looking for a more safe return, 1.5% monthly is going to generate over 18% a year, about 22% a year return if you're compounding monthly, and that's what you want to see. So doing 1.5% a month, you're adding in $250 to your account, and we're compounding monthly. Your initial $10,000 deposit is going to be sitting at 28K in that 3-year period. And I know that's not really what you want to see. You want to see that sitting at 300,000 or more, but it's just not realistic. This is what you really want to be looking at. This is what you want to be doing long term with a lot of capital. And yes, it is difficult to raise capital. And yes, you might not think it's possible now, but trust me, the more capital you have and the more capital you can raise, the easier it is to trade in a sense, because you're going to be looking for so much less return. If you're trading a 100K account and you do 2% that month, you might be satisfied. Whereas if you're trading $1,000 account and you do 2%, you definitely won't be satisfied. So I think you need to do everything you can to raise capital, work your jobs. You don't necessarily need to raise that capital in trading. That's what a lot of people, or where a lot of people seem to miss the ballpark. It's not to say you shouldn't raise that capital in the trading industry, but you don't necessarily have to make all of the money in your trading account from your trading account. And just looking at long-term rewards again, if you start with 10K, you deposit almost nothing, and 3K a year, and you'll end up with 94K after 8 years, which isn't insane. And a lot of you won't be too happy with that, but this is the type of view you need to have, because as you keep compounding, it just happens faster and faster and faster, because we see like year 1, you get $2,200, year 2, 5, year 3, 9, okay, year 4, 15, year 5, 23, year 6, 33, right? So it's starting to get really, really fucking crazy. And this is obviously accrued, but seeing that the total amount of interest you're earning, like look how it grows from year to year. And that's really awesome to think. But yes, enough with that. And then a last long-term rewards. If you can manage to deposit an additional $12,000 yearly into your trading account and you begin with 10K, think about this. This is over a 9-year period. And I know it sounds like such a long time, but that's between kind of you going to primary school, heading through high school and all that. It's not that long. You need to be thinking about investing in this sense. Okay, it's going to take quite some time, long term. Okay, that's how you want to look, and that's how you're going to survive. Okay, the first few years you're not making too much, right? You're not making much at all. But look at the difference in growth between year 6 and 7, year 7 and 8, year 8 and 9, right? It's monumental. It's absolutely crazy, and that's just the power of compounding. And when you get to that larger account balance, you can start comfortably living off trading, but it's very difficult to do if you can't raise capital or you don't have some capital to your disposal. It's all about getting to that point, and then EAs are perfect for you. But enough about that. This is what I want you guys to take away. It's just that long-term view. And if you would like to know a bit more about our EAs and how we go about taking on the market, please head over to arielfxtrading.com. Check us out on Instagram at arielfx. And yeah, I hope you guys have an awesome day, and I hope that you found some value in this video.
Hey folks, ever wonder what broker I use? Well, I use HankoTrade. It was a no-brainer because I was looking for a broker with good trading conditions and one that wouldn't restrict my leverage. Now, by joining HankoTrade, I've also cut down my trading costs significantly with their super low commission of just $1 per 100K. You can learn more at hankotrade.com or just click the link I've put in the description. All right, folks, there you go. Now, if you do want to get access to that bot, then I'll put a link under the video here. So if you do want to hit that, you're going to find out more about Ariel Fx and the bot that Charlie's just been explaining. Also, guys, do remember, hit subscribe, hit like, click on that notification bell, click all, and we'll see you in the next video.